In cryptocurrency markets, prices rarely move in straight lines. They snap, crack, and gap in seconds. Traders operate with constant anxiety that the floor could drop out at any moment. That anxiety usually centers on one specific scenario, the death spiral. If a major institutional investor runs out of cash, they are forced to liquidate their holdings, driving the price down, which triggers margin calls and forces even more frantic selling. Because of this persistent threat, retail investors are conditioned to freeze whenever a massive transaction flashes across the ledger. The instinct is to assume any large movement of coins is the first domino falling. Often, the collective panic anticipating a crash does far more damage to retail portfolios than the actual mechanics of the market itself. Over the weekend, the market received exactly that kind of terrifying alert. A major corporate entity, Strategy, quietly executed a massive liquidation of their digital treasury. On paper, the raw numbers read like a distress signal. 3,588 bitcoins sold off, pulling $216 million of value out of the ecosystem in a matter of days. This visualization puts that $216 million headline into perspective. Strategy still holds over 843,000 bitcoin. That 3,588 coin sell-off is a tiny fraction breaking away from the massive core of their treasury. But the size of the remaining treasury doesn't answer the main question traders are asking. Did Strategy sell because they finally ran out of fiat currency and had to? To survive in this market, you have to look past the scary top-line number and pull apart the actual corporate mechanics behind the trade. We don't have to rely on market rumors to figure out why a publicly traded company moves 9 figures of capital. By law, they have to file mandatory financial disclosures to explain exactly what they did. Strategy filed an 8K with the Securities and Exchange Commission, putting the forensic details of their transactions straight into the public record. This timeline tracks their trades. On Monday and Tuesday, Strategy sold 1,363 Bitcoin, near $59,000. Then they waited. As the market rallied later that week, they executed a second, larger sale near $61,000. Breaking the trade into tranches capture upward momentum for higher yields. A desperate company facing a margin call takes whatever price the market offers immediately. This data reveals a highly calculated operation designed to maximize return. The trading data proves they weren't panicking, but it still leaves the question of why they needed $216 million in cash right now. For that, we have to look inside the boardroom. Public corporations issue preferred stock, which comes with preferred stock dividends. These are rigid, mandatory cash payouts owed to their high-tier shareholders on a specific schedule, regardless of what the crypto market is doing. Beyond those dividends, Strategy also utilized the sale to replenish their fiat cash reserves, ensuring they have the standard working capital required to cover daily operations. Liquidating a small percentage of a digital treasury to meet mundane, scheduled corporate calendar obligations is a sign of a healthy business operating normally, not a firm in distress. Analysts at the research firm Bernstein dug into the company's balance sheet to see exactly how close Strategy actually is to a cash crisis. They examined the company's liquidity position, a metric that measures a firm's ability to quickly access cash to pay its immediate short-term bills. Bernstein's audit reveals Strategy holds enough fiat to cover dividend and interest payments for 17 months without selling a single coin. With this deep runway, they act as a balancing force, absorbing market volatility rather than contributing to it. They aren't liquidating assets to survive. They are actively managing a multi-billion-dollar balance sheet using the exact same treasury strategies as any legacy corporation. The cryptocurrency landscape is maturing. As institutional adoption continues to grow, massive corporate treasuries are becoming a permanent fixture of the market. This logic tree breaks down how we need to interpret large movements of capital going forward. On the left, distress selling leads to forced capitulation and lower prices. On the right, operational selling represents a steady, healthy recycling of capital. A massive transaction by a major holder is no longer an automatic signal to panic. It is often the right side of this tree functioning exactly as designed. As Fortune 500 companies integrate digital assets into their standard operations, 9-figure liquidations to cover payroll, dividends, or corporate acquisitions will become entirely routine. The next time a whale moves hundreds of millions of dollars, the response shouldn't be a race to the sell button. The response should be an immediate check of their liquidity coverage and corporate calendar. Understanding the financial engineering behind the trade allows you to see the market clearly, avoiding the costly mistake of selling the bottom based on a rumor.